The turmoil in Washington at the start of 2018, triggered by the release of the book Fire and Fury Inside the Trump White House, may well be a harbinger of what is in store this year, a year in which the midterm elections take place on the 6th of November. All 435 seats in the House and 33 of the 100 seats in the Senate will be contested. History is not on the side of a positive outcome for the Republican Party. Since 1934, only twice has the party of a first-term president gained House seats in the midterms. F.D. Roosevelt in 1934 and George W. Bush in 2002. The average seat loss is 23. The Democrats need to win 25 to gain control of the House and only 2 to gain control of the Senate. Generic congressional polls put the Democrats between 10 and 15 percentage points ahead, enough to gain control of possibly both the House and the Senate. 2 factors will be key to the outcome of the election. Firstly, the health of the economy, and specifically whether there will be evidence of the benefits of tax reform across a wide spectrum of US households. We are skeptical of that. Secondly, the direction of the Mueller investigations take will be crucial. If these investigations move closer to President Trump himself and unearth damning evidence of criminality, it could further damage the Republicans' prospects in the elections. A poor showing for the Republican Party could fuel speculation of impeachment or resignation. Additionally, a more isolated President Trump could encourage a shift towards implementing populist policies on trade protectionism. We believe an announcement by President Trump that the US is pulling out of NAFTA is an increasing risk. A potential increase in political uncertainty and global trade tensions this year will likely reinforce our view of dollar depreciation in 2018.
Brexit developments will come into greater market focus in the year ahead. The clock is ticking for the UK and EU to reach a final agreement on withdrawal terms before the end of the Article 50 period on the 29th of March 2019. EU Chief Brexit Negotiator Michel Barnier has already warned that negotiations covering both the transition and other withdrawal issues must be completed by October to allow sufficient time for legislation to be passed. We are optimistic that a quick agreement can be reached on a multi-year transition period, perhaps as early as by the next EU Leaders Summit in March. The EU's and UK's views over a potential transitional arrangement already appear closely aligned, which should dampen the risk of more drawn-out negotiations. The EU is currently in the process of finalising its negotiating mandate for the transition. The draft document has already set out that the EU would accept a transitional arrangement in which its laws would still apply to the UK as if it were a member state, but it would be excluded from decision-making or governance of the Union. The UK would also have to continue accepting the 4 freedoms of the single market and the jurisdiction of the European Court of Justice. In return, the current status quo for trading relations would remain in place for a further time-limited period, perhaps up to the end of the current EU budget period at the end of 2020. Securing a timely transition agreement should be one of the UK government's first key priorities for this year, as it seeks to implement a smooth and orderly Brexit. The sooner a transitional agreement is reached with the EU, the greater reassurance and certainty it will provide for businesses, households and financial market participants. The pound should strengthen as fears over a more disorderly Brexit are scaled back, lifting cable back above the 140 level in 2018.
In our topics note on the renminbi, we revisit credit risk and found it rising in China in 2017. One cause is gross exposure in China's shadow banking system, in which some parts of China's shadow banking system may have been growing faster than shadow banking itself. By far faster, we mean 3 to 4 times faster in the last 3 to 4 years, so that some elements of China's banking system may have been growing at 80% a year or even faster. We think one notable lesson from the global financial crisis is you don't measure risk by net exposures alone, because in an actual crisis, liquidity evaporates so that the value of the collateral you hold is not worth the paper it's printed on, and gross exposures matter after all. We're watching closely to see how seriously China reins in leverage to begin 2018. For all the well-meaning technocrats there, the deleveraging goal conflicts with the income doubling goal to 2020. And in China, the growth goal usually wins. And China remains vulnerable to an exogenous shock, what Donald Rumsfeld will call the unknown unknown. One unknown unknown is the valuation of assets on China's balance sheets, particularly in some troubled state-owned sectors. Anything badly valued could have a first-order impact on a banking system that's collateral-based, and by extension, to all of Chinese finance. Whatever the outcome, good or bad, how China turns in 2018 will have a global impact.
MENA regional activity continues to be dominated by low oil prices and geopolitical uncertainty. Whilst most MENA oil exporters have sufficient savings to cushion the sizable adjustment needed to structurally transform their economies to a more sustainable model, the prolonged period of low oil prices is testing available buffers, highlighting the risks associated with the continued dependence on the cyclical nature of oil and gas revenues. Although oil prices have witnessed a marked improvement following the OPEC and major oil producers production cut agreement back in November 2016, which has eased the impact on fiscal and current account deficits, the adjustment process is far from being done. We take comfort, however, from the composition of fiscal consolidation plans, which are being designed so that the negative impact on growth is minimized. Efforts on reining in current expenditures include limiting growth of public sector wages and reducing energy subsidies. Also, they are prioritizing capital expenditures to focus on the quality and efficiency of project spending. In conjunction, there are plans to raise non-oil revenue collections, primarily through corporate taxes, import duties, and the implementation of VAT, which are all accompanying efforts to contain spending. Attending to growing financing needs in a low oil price environment is driving the GCC states to increasingly diversify their sources of financing, with our models suggesting that the GCC's cumulative gross financing needs could amount to $69 billion in 2018 and $149 billion for the region between 2018 and 2022. Finally, we view the impact the geopolitical climate continues to have on the economic function and policy formation within the MENA region as central to the outlook. The escalation of tensions between Saudi Arabia and Iran continues to set the tone. Whilst heightened animosities between these two nations is unlikely to lead to direct military confrontation, an intensification of proxy conflicts in Iraq, Syria and Yemen is likely to undermine stability, continue to drive increasingly unaffordable military spending, and cause supply-side oil disruptions. In addition, the dispute between Qatar and the Saudi-led alliance is nearing its 9th month, and fragmentation of the GCC as a bloc raises fresh questions over political order against a backdrop of rising geopolitical tensions.